Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. 4 weeks ago, the market turned north. It was turned by a combination of a congestion zone stretching from about 540 up to 566, last seen between November last year and January this year, and earlier between late July to late August last year, plus the purple declining neckline of the February to April 2024 reverse head and shoulders bottom, currently at 547. The bright red lower tine, also currently at 547, of a very shallow late August to mid-January bullish shift pitch walk, plus the fret below the 38.2% absolute Fibonacci line of 521 that had supported the market back in August last year. Overhead, we had a pair of moving averages close together, and to be honest, these did not provide much support on the way down, and there wasn't much on the way back up. But, as I said 2 weeks ago, and I quote, the flatlining green short medium moving average, currently at 571, and a very slowly declining medium moving average, currently 565, these two, along with the short moving average, currently at 561, are right now forming a bow tie formation crossover. The moving averages are not in the right order, but they are most definitely forming a bow tie pattern, with, right now, some slight bearish overtones, though this, of course, may change. So what you have to look out for is in between the 15 to 20 sessions from today, so that's last week, so between the 4th to the 10th of April. Look out for one or more of the following: a change in trend, a reinforcement of a trend, and volatility. End of quote. This left behind in its wake ever since at least mid-January, and realistically it could be seen as since late November last year, a V-top pattern that's part of a larger bump and run reversal top pattern. The question I posed last week was whether the market would extend the move lower below the congestion between roughly 540 to 566. Today it has done so, but it is still only 1 day and we haven't had a close there yet. However, the move lower has been impressive enough for me to further endorse what I said over the last 4 to 5 weeks of and I quote, a V-bottom, one that may be building up to a possible bearish half hesitation. This is one course of action for sure. End of quote. I also thought about there being a possible diamond pattern type, but the idea of a bearish half hesitation is attractive. It will all depend on what the market does on approach and at the key August last year low and 38.2% absolute Fibonacci line, both at 521. Thus, I have not as yet laid any targets below for any bearish half hesitation. It's too early right now, but I can indicate a potential of, say, down to the 500 even zone, a historical congestion support stretching down to 495 from there. If, on the other hand, the 38.2% Fibonacci line holds up the market as it did before, then we have the opportunity of a possible double bottom, but it all depends on what happens at the 521 level. Finally, I have drawn a new mid-February to mid-March bearish Andrews pitchfork, an acute one, to help show the bearish angle of attack. The upper tine, currently at 553, has been breached a number of times, but I still favour it for the moment over the shallower bearish shift pitchfork. Chicago corn. A major move was seen here at the end of February and going into March. The end of the upwards move we've seen since the start of the year, and a quite sharp move lower. The key features were the consecutive closes below the early December 2024 to late February this year uptrend, which was also the lower trend line in a mid-January to late February ascending wedge pattern, plus moving back below the significant 50% Fibonacci line of the June to August 2024 move of 505. Prices broke down further below the congestion band 491 to 498. The reason for this turn and fall lower were laid out by me 6 weeks ago when I said, and I quote, we still might see further hesitation, as though the topside seemingly has limited resistances. The ones it does have, and there are two significant ones, they're likely to cause some second thoughts, end of quote. The fall pushed down through the short medium moving average, currently at 485, which had between September and December 2024 shown a significant support to this market. Then 3 weeks ago, pushing below the bright red lower trend line extension to the July 23 to January 24 descending triangle. That's currently at 461. And also the slowly rising mauve medium moving average, currently at 467. All the way down to the fairly free zone actually, till the flatlining gold long moving average below, which is currently at 442, where prices were stopped dead, just short of it, and then pulled back up. The pullback up has been interesting as it stopped on the closing basis at the 38.2% Fibonacci line at 472 of the whole recent move down during the last 5 weeks. So late last week, prices have peaked again at that 38.2% Fibonacci line, and this week taken a flyer on the downside, down through the mauve medium moving average and the bright red trend line extension, down to lows not seen since early March. Last week I said, and I quote, "This all raises the question," as I said last week, so that's 2 weeks ago now, and I quote, "This all raises the question, as I said last, whether we have potential here for a further bearish halfway hesitation or a double bottom. It is too early to say right now, but I would also now add the point that we might have a possible ascending triangle pattern formed during March," end of quote. Well, this week we have seen the market break down lower out of the ascending triangle pattern, leaving us a small double top pattern. Now the primary target X at 453 for this ascending triangle pattern was reached today, and it has the harder to reach secondary target X1 down at 442. We now have, as previously mentioned, a small double top pattern as a result of this action. This has a primary target X2 down at 443, not too far from 442, and a secondary harder to reach target X3 down at 435. Now to offset this bearishness, I drew last week a late November 2024 to early March 25 bullish shift pitch hook for the recent move. The market is now approaching the lower time below, currently at 447. Right now I do not see much confidence in this pattern, but it's still there nevertheless. The reason I have low expectations is because of the possibility that the whole mid-February today action could be a bearish half hesitation. It's too early to confirm this, but if it is, then a potential, not a target, but a potential on the downside would be in the 408 zone. And that's quite a significant fall if it comes about. It will all depend on what the market does on approach and at the gold long moving average at 442. Now, this gold long moving average is not a line in the sand, but it is a pretty close impression of one. Kansas City wheat. 4 weeks ago, the market turned higher. It was turned by a combination of a congestion zone stretching from about 540 to 566, last seen between November last year to January this year, and only between late July and late August last year, plus the March 24 low at 551, and perhaps most important of all, the dark blue lower time of the very shallow late August to late November 2024 bullish shift pitch hook, currently at 544. Now there is a valid argument to say that you could remove this shallow bullish pitch hook and just use the early December 2024 lows, especially the low closes, as a support that finally stopped the decline, but I'm not bothered either way. Since then, the market moved higher still, back up over the unusual purple lower trend line, currently at 570, of the November 23 to April 24 descending triangle, as well as the flatlining mauve medium moving average, currently at 576. The green short medium moving average, currently 589, and the gold long moving average, currently 580, as well as back over congestion between 550 to 570, dating from November last year to January this year. In the overall picture, much like Chicago wheat, the market here has been the story of what's been left behind in the wake of this market, ever since at least early December last year, which is a longer period than seen in Chicago wheat, and that is a V-top as part of a larger bump and run reversal pattern. However, the difference here has been twofold. It's been the dark blue lower time of late August, early December 2024 bullish shift pitch hook, instead of the bullish Andrews pitch hook seen in Chicago wheat, providing a shallower angle for this pattern. Plus, we do not have a bow tie formation of the moving averages here. Additionally, the bump and run reversal top is of a shallower angle compared to Chicago which for a while gave the market the opportunity to try even lower, but which it chose not to undertake. 4 weeks ago I said, and I quote, "The market has achieved just about all its goals on the downside move, and it may be that prices are instead organising for a different pattern and new move." End of quote. This proved to be true, and I've labelled these last 4 to 5 weeks as a V bottom, but one that may be building up to a possible bearish halfway hesitation. This is one course of action for sure, but it might be something else, and I have considered the idea of the whole of 2025 being a possible diamond pattern type. However, the idea of a bearish halfway hesitation is more attractive right now, and it will all depend on what the market does on approach to the dark blue lower time, and a little below it the key 38.2% absolute Fibonacci line at 533. This support held up the market in August and December last year, though it was breached but not broken back in August. So I've not laid out any targets below as it's too early, but I can indicate a potential of, say, down to the 527 zone below. This is not too far below the 38.2% Fibonacci line, absolute Fibonacci line, and still does leave the door open for a further pattern development of a possible double bottom pattern. But I will leave that discussion for another day, one where we are closer to the levels, or level. Finally, I have drawn a new mid-February to mid-March bearish Andrews pitchfork, an acute one to help show the bearish angle of attack. We are right now in between the overhead upper time currently at 595 and the middle time below currently at 530. This more acute bearish Andrews pitchfork seems a better fit than the shallower bearish shift pitchfork. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.